Welcome to BT Podcasts. In this episode, find out what actionable diversification strategies there are as investors navigate away from US-centric portfolios. This podcast is produced in collaboration with Barclays Private Bank.
Today, we're focusing on a major market trend, the move to diversify away from concentration in the US dollar and US-centric portfolios, driven by higher valuations and geopolitical concerns. What are the different approaches to portfolio diversification and actionable investment solutions? How do we navigate this increasingly multipolar investment landscape? Welcome to BT Podcast by the Business Times. I'm Howie Lim. For more insights, we're delighted to have Ken Zi, Head of Investments Asia, Barclays Private Bank. How are you, Ken? Ready to dispense some advice?
Thank you so much, Howie. It's great to be here. Very, very exciting time for us here in the markets world. And I'm really happy to share it with your audience today.
We're thinking that a lot of the discussion is centered around de-dollarization, though. So from your perspective, what's the most compelling structural shift? Is it, say, macroeconomic or geopolitical or regulatory even, that is accelerating sophisticated investors' move away from highly US-centric portfolios?
It's really a big emerging trend that we're seeing. Interestingly, I think the most compelling trend actually comes from the behavioral side. It's an area that we study specifically, both academically as well as from an investor sentiment point of view. And what I think is driving it is that people are generally feeling less safety from the established economic order shifting. That move from a rules-based market to something that is a little different. For example, it's not just about implementing tariffs, but you also have to be talking about the shifting assumptions of very long-held beliefs since the end of World War II about trade liberalization. On the other hand, it's also not just about AI investment spending, which is scaling massively for a small number of players, but from an investor point of view, the fear that either it's too much too soon or the last chance to get on the train. I think this is perfectly normal. Across the market cycle, this happens all the time. Every shift comes with these uncertainties. I think the transition from highly US-centric portfolios is actually a fairly reasonable response to those changes. The objective, I think, that we really talk to our clients about is around resilience, capital letters underlined. When we're protecting that potential for future growth, but we need to know what's happening across the rest of the market. Secondary to this, another big structural shift is that valuations play a very big role because US assets are really trading high compared to European emerging market assets. So those who have been investing in the US markets for a very long time, there's a natural inclination to rebalance. We're thinking this is going to continue through 2026.
Beyond currency, though, Ken, are there specific actionable investment solutions available in currencies like the pound or the euro, which you're really familiar with, that offers a better term value or diversification benefits compared to the USD-denominated assets today?
Exactly as you say, around diversification and around value. Let's say a heavily concentrated USD portfolio, extremely common, I would have to say. Diversification benefits in investing in other developed market currencies do have broad investment options, which have been overlooked for a period of time. For us, we're a global bank with a British heritage. This is something we have a broad coverage of. Equities in these currencies are still relatively well known, large market cap names, but fundamentally sit at lower valuations than US counterparts. This ticks both the boxes on diversification and value criteria. And as we've been investing in these markets for a number of years with the same team, this is something that we have expertise on just from our history. If you're talking about value, you might be switching over to the bond side of the market. Whilst the headline yields may not be as high as those in USD just because of the rate environment and the selection of bonds is not as extensive, there's also not necessarily a very high amount of coverage in this space. So structurally, you can find better value names outside this, which also have some divergence to the US rate cycle and actually the policy noise itself. That one is a relatively more technical opportunity, but on a portfolio basis, it gets you to that point of value and diversification.
The thing is, though, Ken, there is a familiarity bias towards the US market. What's the single then biggest practical challenge and solution you might have for, say, Asian ultra high net worth clients that they should consider when shifting their capital into non-US jurisdictions? There are different market norms, obviously, regulatory environments.
I mean, this is a very big and important question. I will go back to the behavioral elements of this. This is something that we see day in, day out, just because we work with clients from Europe, from the Middle East, and from Asia. You can't avoid familiarity bias. You can't avoid home bias. And it comes from simply avoiding the unknown. This is a trust issue, fundamentally. The driving factor is trying to link your long-term thinking and trying to mitigate against that, as well as trying to build that trust in the investment partners that you choose. It's a massive topic. I think the biggest practical challenge, though, is actually getting started, especially if you're in already an exposed or a concentrated position and you need to try something new. So stepping out of your comfort zone outside of that familiarity bias, potentially you need to work with new providers. You might work with new products. So what's the best way to steep yourself in, test the waters, work it through? Is you do need to spend time to learn and work with different providers and understand exactly where your risk appetite, your preferences actually are. My big point is every market does have its own rules and regulations, and that's an inevitable constant in any decision-making process. So having native or like native coverage of different markets is actually essential. Knowing the rules around how to place, who the key market providers are, what are the dynamics over the past couple of years, you only get that kind of comfort and that kind of trust if they have that kind of experience. The second key point that people do need to look out for to help with overcoming this bias is reducing the operational friction in making these changes. And that is working with someone which is more professionally led, or sometimes a little bit uncomfortable for some investors, going to a rules-based approach to rebalancing. Being able to commit to a system which is able to make changes in line with a wider strategy that will increase the diversification over time to specific geographies, currencies, and being able to top up in periods of volatility. It's that kind of discipline that can also help. You're not committing to a person, you're not committing to an idea, you're committing to a system that you believe will benefit you over time. We do tend to help clients develop both what that looks like in the short term, the medium term, in order to kind of lead towards the long term. So that investment phasing, strategic asset allocation approach is critical on that journey.
Let's go to the other extreme of familiarity, so to speak. You've referenced high-grade emerging market investments outside the US as a source of diversification. Where in the EM universe are you currently seeing the most compelling, say, combination of yield, quality, and low correlation to traditional US assets, that is?
I mean, that is a fantastic question. And we've done a lot of work on this in particular. Sometimes when you look at EM, you're thinking about the wrong set of countries of where it actually sits right now. People don't know that a large number of the countries in the Middle East have extremely high government credit ratings. You can still hold a huge amount of highly rated investment grade names across Korea, the Middle East, South American countries. So emerging markets has been evolving for the past 40 years. Fixed income, in particular in emerging markets, is where the anomaly is to us. It has strong yield and quality characteristics. The duration, in terms of the risk that you get from the interest rate, is manageable. And the idiosyncratic risks can be controlled because the universe is actually increasingly broad and very much evolving. So not just your pure play commodity names or anything like that, you're getting really interesting investment stories that do come out from that wider universe. This premium really rewards specialist teams who work across the universe, who can pick up on these underrated opportunities whilst other people are still focused on the US. We're focusing on Asia and the Middle East, particularly pay off in the fixed income space, where the quality of the underlying names and even the ratings of the governments themselves are less well known. Total return on EM debt indices was roughly around 10% last year in USD terms. That's not too shabby compared even to US equities, with the advantages of yield income, investment grade quality, and low correlation all bundled together. You can see why it's a really hot topic at the moment in the ultra high net worth and family office space.
Still to come, where are the most promising non-US innovation hubs we should consider? And where should we prioritize diversification? Are we talking geography, asset class, etc., etc.? More with Kenzi from Barclays in a moment.
And now back to BT Podcast by the Business Times, produced in collaboration with Barclays Private Bank.
Welcome back. What are truly differentiated investment solutions, Ken, for private clients in the context of this multipolar investment landscape?
I think the answer is within the question. So, multipolar investment landscape is really talking about divergence. Either we need to find something very universal in its necessity and utility, in the sense that everyone needs it, everyone will use it, or we have to split bets and diversify into those multiple poles. In this respect, outside of the trends that we've already been talking about earlier, I would highlight two things. One, our recent 2026 Outlook has a very specific article on the electro-tech economy. What we mean by that is that the infrastructure of energy is so vital that supply factors such as clean energy, demand factors such as electrification of industry and data centers, and connectivity, specifically about battery and storage capacity, are all aligned and strong given the long-term opportunity. So that fits into the first of those, which is talking about something that everyone needs and everyone will use. Two, if we're really looking at something that can diversify and work to different types of valuation, different types of market environment, the approach is to be less cyclical and build longer term resilience against volatility. And that often points towards a stronger reallocation to alternative investments, particularly private assets, which are much more heavily driven by manager-led value creation, whilst public markets will inevitably react more to policy and AI cycles. The trade-off to that, of course, is around illiquidity, long-term timing, and a lot of burden in selecting the right manager for, not just the next 3 years, 5 years, but the next 10 years. So there are different solutions, but definitely different ways to navigate for different investors.
What about the most promising non-US innovation hub for long-term capital allocation right now? And are there specific risks that we should be, or investors should be hedging against whilst they're looking outside of Silicon Valley?
This is actually one of the reasons why we have been quite worried about US-only portfolios, as we do see that significant innovation comes out of other centers. In the AI space, it would clearly be China, which is developing its own parallel ecosystem. It is not a secret, it is barely news necessarily that the supply and demand of the hardware, the software, is running a very different way compared to the US. We already saw the impact of a launch of China-developed language models with DeepSeek, as well as the speed of adoption, which makes it both a very large and rapidly evolving market. Some investors will see this as a natural hedge, though accessing the market will have its own risks and may be difficult for a number of foreign investors. Mainly, we would consider this another reason to ensure proper diversification in the portfolio. And that leads us a little bit back to, whilst China is a hub, the way that you access it, the themes that you play will be different from investor to investor.
What else do you come up against when you're trying to convince an investor with a highly concentrated, successful US-only portfolio to switch to something more diversified? I mean, what sort of misconceptions do they have? Cognitive bias that you're battling against?
I mean, I would see this is still very much a behavioral finance issue. And either you're running up against this has worked for me in the past, or other options are not familiar to me, to paraphrase. As with any advisor, we need to find the common ground and build comfort when moving forward so that we can manage the risks and seek new opportunities. This goes back to my other point, which is all about building trust over time. We have to walk through many, many different viewpoints when we're working with clients, and the reasons that people can be concerned about the state of the market or how they want to work it through is very specific and bespoke to the situation. The ultra high net worth and family offices that we work with need that one-to-one service and the relationship aspect before we can work through the numbers and build the right solutions for them. That said, every journey needs to start somewhere. And we have the patience and the longevity to hopefully match with the clients throughout the process. That is, of course, as long as we do actually get started.
Oh, no. Okay, let's say the primary goal is resilience, then. Let's get to that $1 million question, right? Where should we be prioritizing? Where should investors prioritize their diversification? Is it geography, currency maybe, or asset class diversification? Because we want to implement that beyond US dollar strategy, right? And the current market environment is such. What do you reckon?
I think exactly the $1 million question. And hopefully I'll get $1 million for this question. If the goal is portfolio resilience, I would put geographic diversification first, as there are significant non-US USD investing opportunities available. From a practical standpoint, this is lower friction for a lot of the clients, especially if the investors have no desire or need for things in other developed market currencies like euro or sterling. So low-hanging fruit is your geographic diversification. The currency diversification is secondary to that because it adds sophistication. It does add some complexity to the portfolio management. You get a little bit more volatility because you are introducing currency risk into your performance, but it's a further hedge against USD movements themselves, which have been very vast in previous years. On a finer point, asset class diversification and asset selection can only really occur after you've agreed those other points, as it's really more art than science. That's why we spend so much time with the clients directly to leverage both our thinking as well as the wider firm's insight. And we often consult with internal and external experts to find the right solutions. I think my takeaway as a result of all of this is just for investors to think if this applies to your portfolio, and if so, how best you can move beyond USD in a controlled, efficient manner. If that resonates, finding the right partner for that can be key.
Ken, I wish we had more time. Thank you so much for your insights today.
Thank you, Howie. Really appreciate it. Anytime.
Ken Tze, Head of Investments Asia, Barclays Private Bank. This has been BT Podcast by the Business Times. I'm Howie Lim.
This episode of BT Podcast was produced in collaboration with Barclays Private Bank.
Find more BT podcasts at businesstimes.com.sg/podcast or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.